So good morning, everyone. We are in the middle of a long weekend. Really appreciate you taking out time. We will start right away. We did send emails and reminders over WhatsApp to most of the clients, but in the interest of folks who've joined in time, we'll get started. So Manoj will, as usual, talk about the overall scenario in terms of the economic outlook, both globally as well as specific to India, growth, inflation, capital flows, FPI flows, etc. He'll also touch upon COVID and the geopolitical issues, and then we'll get into specifics on our portfolios and answer any specific questions that people have already posed related to the stocks. So we budgeted about an hour time, so we'll start on time. Over to you, Manoj.
Thanks, Ram. Good morning, everyone. Thank you for joining. So without any further delay, let's get started with our wrap on the economy and the markets. As usual, I will talk on the macro scenario, and it has become customary to start with COVID. Thankfully, its impact is now almost insignificant. So far as the numbers go now, India appears to be in control. Governments have officially given announced that masks are no longer mandatory. So those who are wearing also have stopped wearing now. So which is good, and our numbers seem to be quite in control. We're still seeing a decline in daily cases, but COVID is not completely out. Particularly if you look at the world scenario, we are not out of the woods yet. The new variant, I think it's called XE, is creating a lot of issues, particularly in Europe, South Korea, etc., where daily cases are in excess of 1 lakh. And given that we've completely given off our caution, and there are sporadic news of unconfirmed news of XE cases being detected in Mumbai and even 6 cases in Telangana, we cannot totally rule out a major rebound with respect to COVID. So it is in our own good and in the good of the country that we remain careful and cautious with respect to this particular virus. Having said that, we continue to maintain that unless we have exceptionally difficult circumstances, we will not see lockdowns. And our prediction for wave 3 came to be true. We said that the impact of COVID third wave will not be significant, and that's how it has happened. So economic impact, unless situations are very, very abnormal, are likely to be causing insignificant impact on the economy. The economy is almost back on track. However, now after discounting the COVID effect, after saying that COVID is not impacting the economy, the numbers are not looking as great as we would like them to. There were so many projections. The IMF, the World Bank, our own Reserve Bank of India, and institutions like CRISIL have all cut down on our growth estimates. A whole lot of reasons, and we will get into them. But the growth rates that we were expecting when we discussed this issue 3 months down the line are unlikely to be seen. As per latest RBI estimate, our growth for the current fiscal, that is 22-23, is likely to be in the range of 7.2%. Okay, good growth, but not as we were expecting and as we would have liked. A major concern across the globe is inflation. Okay. So the geopolitical situation, or specifically the Ukraine-Russia war, has had a huge impact on inflation across the world. Oil prices have shot up, commodity prices have shot up, and liquidity is drying. Central banks are forced to rethink on their strategy of having a low interest rate regime, particularly because of the increase in inflation. US is seeing unprecedented high levels. It has crossed 8% now. At least ever since I have been tracking economies, which is for the last 30 years, I have not seen US declaring an inflation of 8% plus. Even in India, we are now outside the comfort range of RBI's 4 plus or minus 2%, that is 2 to 6% range. Inflation is now around 6.95%, and with almost daily increase in fuel prices, we can expect inflation to further increase, which means sooner than later interest rates will have to be increased. You know, the RBI was very, I would say, bold in stating that it will do whatever it takes to maintain and support the economy and ensure growth. This is maybe technical to some of you, but the primary objective of a central bank is to control inflation and not so much worry about growth. That is the objective of the monetary policy. Growth is essentially responsibility of the central government, and the central government will have to use the fiscal policy to spur growth. However, what we have seen ever since the exit of Dr. Rajan is that both central bank and central government have aligned on the growth to be focused on the policy to be focused on growth. And therefore, we've taken a lot of steps, and I would stick my neck out and go to the extent of saying that we have tried to keep interest rates low. And even in the recent monetary policy announcement, the RBI was very categorical in saying that we continue to have an accommodative policy, and it did not change interest rates. However, it did went on to say that they will reverse from the accommodative stance, neutral, and then maybe whatever it takes. Now, while that is the policy stand, we must understand that what the RBI states is only symbolic and directional. The banks are not bound to change their interest rates based on what the RBI does with the repo or reverse repo or any of its rates. The banks are free to charge and to offer whatever interest rates they feel is right for them. And we have already seen banks increasing their deposit rates even before the policy was announced. The yields on government securities have already run up. Okay, we've seen more than 100 basis point increase in government securities. So, like it or not, we are now looking at interest rates going up, which is not good news for either the debt market or the equity market. Now, to connect the dots, it is not good news for debt market because if interest rate go up, existing bond prices come down, which means if you are holding, let's say, a debt mutual fund, the NAV of that fund will see a temporary decline. So you will get negative returns, which is again counterintuitive. How can debt give negative returns? But do understand that it is a temporary phenomena. And as fresh money gets invested at higher interest rates, ultimately the returns catch up. And if you stick to your investment philosophy, we recommend debt funds only if your investment horizon is 3 years or more. And during that period, the returns will catch up. So while you see that temporary dip, do not be concerned about it. Coming to the equity market, an increase in interest rates increases the cost of funds for businesses. So theoretically, the businesses become less profitable unless they are able to pass on the additional costs, which again will have other problems. So there is a dip in profitability because of increase in interest rates, and that is also not taken positively. However, we need to understand that Jamā Wealth has consciously chosen companies with zero to minimal debt in its portfolio. So an increase in interest rate will not have a direct impact on profitability of our portfolio companies, and therefore the impact is likely to be less, provided the market is rational, which need not be the case. When the market, the very announcement that there is increase in interest rates will lead to a fall in market, and irrespective of what type of company we are talking about, generally speaking, all companies experience a dip. However, sooner than later, the markets realize what is the implication of the higher interest rate on various companies, whether they are lenders, borrowers, etc. And accordingly, the market adjusts. So my suggestion to you at this point in time, because there's so much of talk of interest rates and we give so much of weightage to the macro factors, my suggestion to all our participants here is not to be unduly worried about these aspects. Yes, there will be impact, there will be volatility, there will be ups and downs, but that's not something which we need to worry about in too much of, we don't need to lose sleep over this particular aspect. We have to ride this turbulent phase. Now, there is another point that is being widely discussed, and that is that FIIs have been selling. And of course, even in my earlier discussions, I have raised this point. The participation of foreign institutional investors, domestic institutional investors does play an important role in stock markets. And that is purely from the perspective of liquidity. Okay, more money coming into the markets see an uptick. If money is being pulled out of the market, then the markets see a dip. Now, what is happening is, since October 2021, that is for a good 6 months of time, FIIs have been net sellers. And even after you account for the net buying of domestic institutional investors, if you combine FIIs and DIIs, we are having a negative figure, meaning there is a net sale, which obviously has an impact on the market, and that is the reason why we've seen markets go down. Okay. We've had Philips, so not the company Philip, I'm sorry. We've seen markets move up when the budget was announced. So the markets will continue to play, but let us understand, the objective is to explain to you this impact of capital flows and what is happening, and is it again something that we need to worry about. So now the focus is on FIIs being net sellers, which is understandable. Okay, they are buying, let us say, 100 rupees and they are selling 150 rupees worth of stock, so they are net sellers. Now, this is not a verdict on India or Indian markets. When they are selling 150, they are also buying 100 rupees worth of stock, meaning they continue to invest. It is just that the portfolio is shifting, shuffling, and there's a net reduction to the allocation that is being made to the Indian markets. And this is not linked to any factor That is India specific. Now, for example, Indian economy is crashing, or there is breakdown, there is political uncertainty. There's something which is specific to India, and that is causing the FIIs to pull out market is a cause of concern. This net sale is very similar to what, as an individual investor, we do every 3 months. We rebalance our portfolio. Okay, we look at what we are holding, and we may want to shuffle it a bit and maybe take comfort in safety. Now, what I say might be a little, may not be the right way of explaining it, but I'll anyway go ahead. Let us say there's a bomb blast in the city. Or a serial bomb blasts are happening at multiple places in your city. There's a bomb blast. Now, what is our first reaction? Our first reaction is to reach home. We want all our family members to reach home. Has everybody come or not? Because it is our perception that our home is very safe, that the bomb blast cannot happen in our house. Never mind if you are living in a building with 200 flats or whatever. It is our we look for safety. And this is exactly what is happening. The foreign institutional investors don't invest only in India. For them, India is one of the markets, emerging markets. And when there are things like a war happening, there is the central bank which is increasing interest rates, there is a flight to safety. You want to be comfortable in your safe zone. And that is the reason why money is getting pulled out of emerging markets like India. But nobody is exiting. Nobody is exiting the market. And when things stabilize, they will come back. Another reason why they do this as a portfolio reshuffle is when things like a war happen, when the inflation goes up, invariably currency of an emerging market depreciates. And we have seen that over the last, I think 6 months or so, the rupee has depreciated by about 6%. If I'm not wrong, my numbers may be a little bit here and there. Let me check. Yeah. Yes, the rupee has depreciated by about 3%. The foreign investor calculates returns in dollars. So in this period, if the rupee depreciates, the dollar returns get, it negatively impacts the dollar returns. So you don't want a scenario where your overall portfolio returns come down because of a currency exchange rate issue. And that is the reason why money is pulled out. And when stability comes, that money comes back. Because India continues to be the most attractive investment destination in the world. There is no denying that fact. And therefore, that FII money will come down. It is a good opportunity for media and analysts for us to talk about this. FIIs are pulling out money, what is going to happen, etc. Nothing is going to happen. This money will come back once stability returns. And for stability to return, we have to look at the Ukraine-Russia standoff. At the first instance, nobody believed that there will be a war. Everybody thought noise is being made and then some compromise will be reached. But then Putin called the bluff of US and NATO, and without going into the reasons of why this happened, etc., because every interested party has its own perspective and we are not going to discuss that. The fact of the matter is the war was not anticipated and yet it happened. After the war started, everybody said this is going to be a 1 week, 2 week issue. It will get resolved. But even now, we don't see its end happening very soon. A lot of other interests, and there's a whole lot of disruption that is happening, particularly in the financial markets. And This is probably the start of the reduction in the value of the US dollar. The US dollar is the reserve currency of the world. Okay, again, little bit of theory. A currency is nothing but a medium of exchange. If I give you a 10 rupee note which is completely torn with plastic stuck over it, you will say, please give me another. Ye nahi chalta. This will not run. Meaning, your decision of accepting or rejecting a currency note depends on whether you can use it to buy something else. Okay, that is the purpose of currency. The US dollar is accepted by everybody in the world because the US dollar is accepted by everybody in the world. I hope you're getting my sentence. I accept the US dollar because I know when I offer the US dollar to somebody else, that person will also accept. Practically everything that you can buy can be bought through the US dollar. And that is one of the reasons why the US did not experience the kind of inflation it has experienced today. Because what is inflation? It is price rise. When does price rise? When the demand is more and supply is less. There's a demand supply mismatch. More people are asking for the same amount of goods. So the seller will increase the price. For the US, if there is a supply constraint, they'll buy from any other country and pay by simply printing the dollar. And the supplying country will happily accept it because it knows it can pay back and buy whatever it wants through the dollar. Now, what is happening with the geopolitical situation today is you are questioning whether the US dollar has to be your currency of choice. Honestly, there is no alternative. There is no other currency which can play the role of the US dollar. And that is the reason why we are saying that gold, which is the original currency, is an asset that you should have in your portfolio. We see gold prices rising further because increasingly people and countries would like to reduce their dependence on the US dollar. And that is something which is going to impact markets quite a bit. So one of the reasons why we continue to have Manappuram and that we will talk about later is because there is a play on gold and we expect gold prices to go up. The other aspect of the conflict, just 1 second, please. Looks like, give me a second. I thought I'll make a point which I'm not able to remember.
Manoj, is it about the asset quality?
So what so anyway, it's not coming. If I get that point again, I'll share, but without losing time because I have already taken a lot of time of yours. The thing is, this war will force countries to relook at their strategies. Countries will now increase their spend on defense because Ukraine is an example that you will have to fight your battles alone. No other country is going to come to fight your battle, and therefore your allocation in your budgets to defense will increase. Second most critical aspect is the food security. Today, even in the developed economies, people are fighting for food. And that is the most basic of requirement. And therefore, governments will increasingly look for having food security. Today, we have to be thankful that we are in India. We are a food surplus nation and we can offer food to the rest of the world. But increasingly we will have to look at, we and every other government will have to look at, how do I protect myself in these kind of scenarios? Which means money that is otherwise allocated for capital expenditure, for welfare schemes, will now get diverted to defense and food security. And that will have an impact on your economy. Thankfully, we have food security and we are increasing, our agriculture output is increasing. So among the, despite the GDP growth not matching up to our expectations, agricultural growth has been better than expected. So we are still in a better position, and therefore, despite our own challenges, we are likely to do well as an economy, and hence invariably the money that is currently moving out will come back, and we will continue to see the rise in markets. I think, Ram, I have covered most of the things. Okay, capital account deficit, etc. I will let go. But so long story short, what I'm saying is that yes, we are in for a period of turbulence. We have seen a prolonged one-way increase in markets. The graphs have been quite steep. If you look at 5-year graph or 10-year graph, you will see a steep increase. Of course, the ups and downs will be there. The small ticks and up and down movement will be there. But very clearly, the trend is up. We may not experience that kind of situation over the next 3-6 months, 1 year or so. There can be a little bit of correction also. And this is where, as equity investors, we need to be very careful. And ultimately, despite all the macro challenges, it is the micros that will matter. Your stock performance will not depend so much on whether the interest rate has gone up or come down. It will depend on what is the impact of that interest rate on your profitability. And so long as managements are cognizant of the challenges that the company is facing and are capable of handling that, we would continue to see performance improvements in quality companies, and that is where our money should be going. With this, I will stop, and maybe when there are specific questions, I will take. Ram, over to you.
Yeah, thanks, Manoj. Yeah, I was checking if I was on mute or not. So that's a good coverage of the macro situation. What we'll do is I'll cover some questions that have already come to us over the last few days. And after that, maybe leave the floor open for any other on-the-spot Q&A. The most of the questions are on the portfolio. So what I will do is I will straight away talk about how the portfolios have performed, and we can take specific companies as an example. We typically don't, it's a long-term portfolio, so we encourage our investors and ourselves not to look at, is mahine mein kya hua, is quarter mein kya hua. But still, I think it's important to keep sight of what's going on. So one question was that the portfolio has lagged over the last 12 months. And where do we see this over the next 1, 3 to 5 years? I'll answer that first. The portfolio, so as you know, we run 2 advisory strategies. One is a large and mid-cap focused portfolio. The second is a pure small cap portfolio. So as far as the large and mid-cap strategy is concerned, we have pretty much been flat. I think both index and jewel have grown at around 21% each in the last 12 months. And if you talk about the last, so in fact, I can share the screen with you right away. share my screen. Yeah. I hope you all can see my screen, right? Brian, can you see my screen? Great. So as you can see, right, Jamā Wealth in the last exact 12 months has grown at 21.3%, whereas Nifty Total Returns Index has grown at 21.2%. So these are the numbers. There's nothing to comment as such here. The last 1 year has been somewhat unusual with so many events happening globally. So the portfolio has kind of held its own. Yeah, we did have certain stocks which, and the names like Ajanta, Manappuram, Lux, etc. have come, and I'll talk in brief about them, which have impacted the portfolio. But despite that, we've been able to hold ourselves. We've completed almost 3 years. So if you see the last 3-year performance of Jewel, this is how it is. And Jewel has grown at, and we launched this on 22nd August. So if I take the model portfolio, Jewel has grown at around 33% CAGR versus Nifty TRA at 20.6% CAGR. The question some clients will have, natural question is, I entered on so-and-so date, but for me, the performance has been this way. So to which we can only say that, look, we can't control on at what time one enters. If you are holding at least a 3-year time frame, one data point you could look at is how has this performed over 3 years. So if I just slide this bar to the left, and it's a 3-year bar, so you can see that over multiple 3-year periods, the portfolio has done, it has actually outperformed Nifty TRA over multiple 3-year bars. And if I take the average of those 3 bars, there is a view that I have, which I'm going to share that as well. Let me say new share. Yeah, so this is a share we have, which is, there's a small PDF that we created summarizing what we do. If you can see, this is a rolling 3-year model of Jewel. And this was taken about a week ago. So the numbers are largely in line with what I just showed. But the interesting thing here is that the purple outlined bars are 3-year CAGR measured on that quarter. And the red bar is the Nifty TRI CAGR measured in that quarter for the last 3 years. So the average of the Jewel portfolio has been 29.3% versus Nifty TRA 11.24%. So this is an expectation in terms of the past performance. Obviously, we can't predict the future, but there's a saying that the past rhymes if not repeats. So you can actually see a sinusoidal curve here, which is very, very interesting if you draw a 3-year performance. It's a sine curve. And given our expectations of the economy, we hope that this trend should kind of continue with an average of, see, even if you make 15% CAGR for a long enough time frame, right? That's a lot of wealth creation opportunity for all of us. Now, the second strategy, which is the Spark strategy, I'll talk about that a little bit. The 3-year, here again, the Spark portfolio tends to be more volatile. So you will see that the BSE small cap has actually been negative at many points in time, including recently in 19 and 20, when there was a significant market correction in 2018, especially. And our average has been exceptionally high. And again, this is mostly backtested data with all its assumptions and caveats and qualifiers and disclaimers. I will show you the 1-year actual model performance since we launched it in June. And that is over here. And I have a real-time view of this, real-time as in a near real-time, which is this view. So from 1st June till 13th April, the Spark portfolio has performed at around 53% absolute versus 25% BSE small cap. And I already showed you the rolling 3-year returns of this portfolio. So why do you, I'm showing all these numbers to you because we are confident that, like what Manoj said earlier, when we systematically and consistently invest in near zero debt companies which have return on equity that is consistently high over several years. And we rinse and repeat that strategy. We rebalance every 3 months so that if a particular stock or sector has run up a lot, we book some gains and push it to the other one which has underperformed. That tends to over time act like a shock absorber or an auto steering, which automatically, steers. So I was driving this car. I went on a 700-kilometer drive over the last 2 days. A car which has an adaptive cruise control, and it checks the lanes and automatically, steers. So I was thinking of how we do it on a quarterly basis to our portfolio. So that is what we do. And as a result, we may not get exceptionally high gains when some stocks run up, but then we also tend to, give a steady and consistent rate of return, as can be seen by the historical data and also the last 3 years data that we have. I can also show you the last 1 month return of Spark. It has not, it has been on par with BSE small cap. So the moral of the story here is that there will be times when, the portfolio will jump up. There will be times when the portfolio underperforms. And we have to basically stay, if we believe in an investment philosophy, we should ideally stay true to that through bad and good times and give it at least 3 years to play out. Now I'll come to a few other questions that were raised. I hope everybody is listening me, is able to hear me, right? Yeah. So the next question was, somebody asked, my portfolio is down 10% since I've joined Jamā. So I think I've already answered that. There will be, we can't time things to perfection, but please look at the rolling 3-year returns. The specific question was, do we expect a 20 to 25% growth in the next 3 years from here? So once again, I'm sorry, we can't predict future performance. We do not have a crystal ball. Having said that, our money is invested in the same stocks and that we advise our clients on. There's another question which is related to Lux Industries. So why did we buy it at an expensive price? That's the question. And what's our take on it? As you all know, Lux Industries, we exited not because we found any weakness in the fundamentals of the stock, but because there was a corporate governance issue. And one of the executive directors was indicted by SEBI. And this happened just a few days before we did the rebalancing. So we didn't exit in a knee-jerk manner. We gave it about 10 days or so to see, more importantly, not just wait for rebalancing, but mainly to wait for how the management reacts. And we were not very inspired by the rapid action taken by management. So we included an exit call on it as part of our quarterly rebalancing. Now, specifically Lux, we did the rebalancing on 30th of November. We added it when the price was approximately 3,800 rupees. And the stock just about 2 weeks before was at 4,500 rupees. Okay. Now, when we typically exit or enter a stock, price is one of the last few things we look at. We more look at, all the roots and wings parameters. And at that time, we were not aware of any corporate governance issue, so we added it. Since we exited, incidentally, we are quite optimistic about the sector in which Lux operates. We did add another stock in the Spark portfolio, which is from the same industry. The other question that I see is, why are we not selling Manappuram when the profits are declining? Why did we sell Supreme with just 1 quarter going bad? Also Astral. Another question came, Ajanta and Manappuram are dragging the portfolio. Why aren't we exiting them? So Manoj already covered a brief about Manappuram when he was speaking about the gold and the geopolitical trends and how he expects gold price to go up from here. So firstly, let's continue on Manappuram. It continues to be a company with high return on assets, exceptionally high return on assets, 6% or so, which in the lending business is not easy to make. It's a company with very high return on equity. The long term as in the medium to long term growth in sales and profits are still good. However, the last 1 year, and again, I'm talking based on the latest quarter results, which came a few months back, 2-3 months back. The year-on-year growth was not good. But given our long-term view on the sector, the post-COVID boom in growth, gold prices, post-Russia war, the uptick in that we are expecting in in the lending space, we would like to hold on to this stock, and the valuation today is significantly below the long-term median PE of the company. The long-term median PE is around 10.1, and today it's trading at 6.8 multiples, which is, given all these factors, we said we'll hold on to it. Again, if had it been a company with either corporate governance issue or in a declining model, we would have probably exited it. Yes, there is competition hitting this company. A lot of competition is undercutting them. But we believe lending is a long haul business, and you can't, companies which come and do dhoom dhamaka in 1 year or 1.5 years may not be able to sustain it after time when the NPS catch up with them. So that's about Manappuram. The other question was, why did we exit Supreme and Astral within 1 quarter? We actually had both these stocks for nearly 6 months in our portfolio. It's not that we took a knee-jerk reaction in 1 quarter. So we held them from August to February, and there was a combination of various factors due to which we exited. Again, we don't want to create a large omnibus portfolio where there are 30-40 stocks. That tends to dilute returns over time. So the confidence we have in a 20-odd stock portfolio, where we closely monitor them, manage them, and rebalance on a regular basis, in terms of the returns we've seen in the past, that's where we are at. But I do take feedback. If there's anything we can do going forward, we'll probably explain better, in future. But it's very difficult in a 20-stock portfolio to just pick 2 or 3 and say, why are these not doing, and ignore the others which are doing really well. So, but still, in the interest of keeping the conversation going, I mean, we want to definitely cover this ground. The other question that came was on Ajanta Pharma. Ajanta also, like Manappuram, is a strong company, very low debt, and both the profit after tax and sales growth in the previous quarter were not super excellent. They were not in double digits, but they were still in the high single digits. And it so happens that pharma has taken a hit in the recent past, and the PE of this particular stock is below the long-term median. So we believe it's oversold. And incidentally, the promoters actually still hold 70% plus equity of the company. In fact, they slightly increased their shareholding, and they even revoked a minor pledge that somebody had, a minor pledge of 1,000 shares. So all in all, we want to hold on to this company. We don't see any reason why we should exit Ajanta Pharma as of now. We'll revisit the whole thing, when the next quarter comes up for review. This quarter is going to be a tough quarter for Ajanta Pharma, mainly because not just Ajanta, but the pharma industry in general, because of the increase in raw material expenditure, and so the earnings might slightly decline. So we are waiting to see how the results shape up. That is the specific questions on the stocks. Now I'll leave. Let me check the chat window to see if there are any other questions that have come up. So Sachin Rastogi at 11:29 a.m. asks us, please share your views on investment in digital currencies. Manoj, would you like to take it up from our friend Sachin?
Okay. See, we've said this before also. The house view on digital currencies is that uh, it is speculative because we do not have a basis to evaluate the intrinsic value of a Bitcoin or an Ethereum or any of those things. And again, to reiterate what I had said, a currency is a medium of exchange. So if, for example, a particular government, say the Indian government says that you can pay your taxes in Bitcoin, then you will see Bitcoin prices rallying like anything because it is acceptance of that currency. And therefore, it becomes a medium of exchange. Similarly, if a particular government says that we will not recognize this currency or it is illegal to transact in this currency, then the currency will lose value. And today, as things stand, the price movement in cryptos is largely speculative, and therefore we avoid investing in these digital currencies. However, if you are a trader or a speculator who is willing to lose money for an opportunity to make some super quick profits, maybe 2%, 3% of what we call as mad money, you can try your luck there. But honestly, for us, there is no basis to recommend or reject investment in crypto.
Okay. The next question is from Amarnath Hari. His question is, what are the annual earnings from fines and penalties for lending companies such as Bajaj Finance? He's concerned about some feedback from the lower economic classes. We don't track this particular data point, but I mean, there are cases where people complain and the lenders, might be subjected to some fines by the regulator also. But see, that's why I was saying earlier regarding Manappuram, when I said competition and the is actually impacting them to some extent, but then it's a long haul business. So in lending, one has to balance between collection efficiency and NPAs. So I have worked in a lending company myself in the past, which has worked with people for whom the target customer segment was predominantly people in the lower economic classes. And I haven't seen any instances where, people are in general abused, for if they default on their payments. Collection is a very tough job, and almost, I would say 99.99% of the borrowers pay on time or after frequent follow-up. In fact, there's a company called Shriram Transport Finance where the very young employees are empowered to go and do collection. And if for some reason there is still an NPA, then the employee is not penalized. The reason is because the employee comes from the same socio-economic strata as the borrower, and there's a lot of personal network and relationship there. So it's a very sensitive business. Maybe I can come back offline to you in terms of numbers, but I would like to believe that the well-run companies and the companies we track have very good corporate governance. But at the same time, they're very efficient machines. They have to be accountable to shareholders, and we don't want to invest in companies which take it easy when it comes to collections. Next question is from Ganesh Mohan. What is your view on ESG as a basis for investing? Sustainable long-term trend, or do you see something that is seeing a bit of a reversal post-Ukraine? How do you see the run-up in ITC in that context? Manoj, you want to take a shot at that?
I wouldn't want to talk about ITC. Okay, ITC is a case study in itself. But See, generally speaking, again, if we look at companies in the US, etc., ESG investing is a sign of good quality management. One of the parameters that we look at in our roots and wings philosophy is the quality of management. So a management that is sensitive to the environment, which is backing sustainability, will be looked at favorably by investors. So over the long run, we do expect ESG companies to perform better vis-a-vis non-ESG company, other things remaining more or less the same. So yes, ESG can be considered into your evaluation criteria, but fact of the matter is, many years back, I remember, I think Tata Mutual Fund had come up with a mutual fund which was based on ethical fund or something. I don't remember. It's many years back, and I don't even know if it is still existing. But the fund didn't do well, because end of the day, the investor is looking at returns, and the returns will come if the company does well. Now, there is a lot of awareness about environment and, in fact, our own survival. Okay, so if there is no environment, then we are not there, and therefore our investing does not matter. I mean, without digressing too much, short answer to Ganesh Mohan's question is that yes, ESG definitely forms part of your evaluation criteria, and we will have to give due weightage to those factors.
Yeah, I just want to add a couple of points, Ganesh. Unfortunately, ESG has been somewhat abused in the global investing circles, especially like you said, after Ukraine, including defense companies in the ESG definition. Just because it suits the political purposes of one party, to us seemed like a slight stretch of the definition. I mean, how can companies which build missiles and bombs, be considered as ethical and socially responsible? That is one thing. And when Manoj was talking about the fact that a company's main objective is to generate profits, which is what we remember Mr. Narayan Murthy used to tell us, 20, 30 years back. That is true. And it's also similar to the question that earlier Amarnath asked about collection efficiency and, fines, penalties, etc. So one small saying that I heard some time back is, when a company tries to be a temple, it can neither be a good temple nor a good business. So, so companies are not meant for charity. And the way the ESG definitions have been twisted around, it's slightly sounds a bit, I mean, I'm personally slightly skeptical about it. Coming to ITC, yes, like Manoj said, it's a case study in itself, but possibly some of the food-related inflation, food-related aspects, and the fact that ITC has got a very strong agri-commodity business might have played up in the recent past. I'll move to the next question. We have 3 more questions and 6 minutes left. Vishnu is asking, can cash-rich companies like Infosys be considered for long-term? It's never part of the portfolio. Okay. I don't know, Vishnu. We do have TCS and Tata Elxsi in the portfolio, which are pretty good. Infosys, yes, Infosys came very close last time, but we prefer to keep TCS over it. There's one structural characteristic about Infosys, and I personally love Infosys. I've worked there for a very long time, more than a decade. Great management, great culture. as long as one of the core founders is on the board and very closely watching the company, it's great. But unfortunately, the entire set of founders combined together still have very low stake in the company in terms of numbers, right? It's still considered their brainchild and their labor of love and all of that. And Mr. Nilekani is on the board. He's the chairman, and that will probably continue for a long time. As long as it's there, there's no problem. But we are slightly worried about companies which are large and where there is no substantial shareholding by one core family or owners or people or institute, whatever you call it. But we are continuously monitoring. Similarly, all other companies, the most of the tech sector is cash rich because they're fairly capital efficient and they generate a lot of cash. So and today the valuations are in the mid 30s. They're high but not exorbitant. We are watching the tech sector also very closely. Next question is from Ramesh. I heard that some new regulations have come up on NRIs buying equity shares starting April 1st. Can you throw some light on that? We'll take that. Yeah, Manoj, do you?
We take it offline, Ram.
We'll take it offline. Yeah. So we'll take it offline, Ramesh. Typically, NRIs have. There are limits on stocks that they can buy, because when foreign holding crosses a certain limit, then, they are not allowed to be purchased. And we've seen this issue happen with some of the stocks in our portfolio. But any specific rules that have come post 1st April, we'll get back to you offline on that. The last question is from Ravi S. Rao. Can you build a separate dividend yield portfolio with the realized profits of portfolio management? We get a ready reckoner of sorts, kind of feel good factor. Okay, so right now we are running two strategies, which is both of them. The underpinning for them is what we call as roots and wings. So essentially, these are companies with very low debt, with very high return on equity, with consistent performance in terms of sales, profit, cash flows, market share. So we track a ton of tons of data points on all of them. We do our own trending, we do our own algorithms on that. We don't do algo trading, but we come up with a shortlisted portfolio upon which then our investment committee then gets into depth and evaluates all the companies. We started the first portfolio, which is large and mid-cap focused portfolio, which is Jewel, nearly 3 years back, and that's done reasonably well. And only after we became very confident about that, which is almost 2 years later, we started our second strategy, which is Spark. So which will be our third strategy? We'll work on it. We are looking at cyclicals as one potential element. We've been watching it. We've looked at momentum closely. We still don't feel that in the current advisory model that we follow, the operating model is conducive for doing a momentum kind of a portfolio, because it requires very rapid action and and tracking the portfolio more closely. And because we don't have contract notes on time or trade books on time, sometimes the portfolios may not be in sync, and that leads to a lot of issues in terms of calculating the right quantity. So that's the reason why we felt that momentum portfolio will not suit an advisory model. Coming to dividend yield, we will take the feedback, but typically, if you're looking for dividend yield as a proxy for debt funds, that's one way to look at it. Right now, our strategies have been largely around equities for growth kind of a thing. Ganesh did talk about ITC earlier, and he did do a study on ITC between 2014 or 2013 to 2020, late 2021. And dividend adjusted growth in ITC stock was hardly 2%. Okay. So there is a perception that companies give, that give high dividend are really good, but for a long-term investor, probably, chasing dividend yield may not be the right thing. Again, there are no right or wrong answers to it. It all depends on the context. So we will look at, if we feel that a dividend yield kind of a portfolio can, beat inflation by a significant margin, that's what we are in equities for. You've got to be in equities where you want to beat inflation by several percentage points, and you're willing to stay invested for the long haul. So there's a lot of philosophical issues here. We'll come to that. However, cyclical is an interesting thing, because if you track some key numbers and do some trending, and I was talking about the sinusoidal curve of the jewel portfolio, that's actually a very, very interesting observation. There could be juice that we could derive out of that. So on that note, we'll end the call on investing. If there's any other question, please do feel free to shoot us an email. You have all our personal email IDs, plus there is advisor@jamawealth.com. We still had nearly 30 plus people join on a long weekend. I'm sure most people are enjoying their long weekends. Hotels are all booked out, flights are all oversold, highways are all full. So that shows that the economy is vibrant. On that note, we'll end this call and have a great weekend.